Most options traders only talk about opening positions. Very few talk about what happens after you've already made money. Today, I'm going to show you a decision that may look strange at first. I didn't sell Coca-Cola because I lost confidence. I sold part of my LEAPS value because I wanted my capital to work harder. When I originally bought this LEAPS, my goal wasn't to hold this exact contract forever. My goal was to own a high delta LEAPS and continuously generate income by selling covered calls. Over time, the position appreciated. The LEAPS delta increased to around 80. That means the option had already captured a large portion of the stock's movement. Many investors would simply hold it, and there is absolutely nothing wrong with that. But I manage my portfolio differently. My objective isn't to become emotionally attached to one contract. My objective is capital efficiency. Here's where capital management becomes interesting. I originally bought this LEAPS for $14.28. A few months later, I sold it for $20.43. Then I immediately purchased a higher strike LEAPS for $13.55. Think about what just happened. I'm still invested in Coca-Cola. I still own a LEAPS. But instead of having $1,428 tied up in one option, I now have only about $740 invested in the position and nearly $700 available to invest somewhere else. That capital is no longer trapped inside one option. Now I can use it to build another income-producing position. For me, that next opportunity is Starbucks. I'm not selling because Coca-Cola is a bad company. Quite the opposite. I still like Coca-Cola. I'm simply choosing to recycle capital instead of allowing one position to become larger and larger. This isn't the only correct way to trade. It's simply the framework I've chosen to manage my portfolio. Options trading isn't just about finding the next trade. It's about deciding where every dollar should work next. Sometimes, the best trade is simply moving your capital to a better opportunity.